If you look at the financial headlines right now, it's a strange picture.
Mm-hmm.
The S&P 500 is, well, it's flirting with all-time highs again. And yet, when you talk to people, to individual investors, there's this fear running just underneath everything.
Low-grade anxiety.
Exactly. It's a fundamental paradox, isn't it? You
Yeah.
have these huge asset gains, but at the same time, this deep uncertainty about the whole system. So the question for you listening is, are we actually calm, or are we just numb to the risk?
That's a crucial distinction. We're sitting here in late 2025, and the whole narrative is really dominated by two massive forces. You've got AI advancements, obviously,
Right.
and you still have the effects of, accommodative monetary policy. But the high valuations that result from that, especially with all the geopolitical tension, they're masking vulnerabilities that are not just cyclical anymore.
Not just a dip.
Not just a dip. We're talking about structural changes, a foundational reshaping of how capital works, where it goes, and who really benefits.
And that is exactly our mission today. We are doing a deep dive into these structural forces, these quiet shifts, and we want to pull out the clearest insights for you so you can figure out how to protect and grow your wealth in the middle of all this.
Yeah.
Welcome to Everything You Need to Know About Finance. And just a quick reminder, this is our deep dive on the topic. It is not financial advice.
Of course.
And hey, if you find this kind of content interesting, please like and subscribe. It really helps us out.
It does.
Okay, so let's unpack this. Let's start with the elephant in the room, the macro picture. Why does the volatility feel so different this time? It feels heavy.
I think that's a good way to put it.
We're walking into what a lot of people are calling the debt and interest rate trap. I mean, we've seen years of the struggle with massive public and private debt, and even with the rate cuts in 2025, the tension it's still there.
The problem is one of fundamental constraint. The high debt levels, especially government debt, they essentially tie the hands of central banks. Aggressive policy is it's almost impossible now. Well, think about it. A decade ago, rates could drop to zero because debt, while it was rising, was still kind of manageable. Now, even with these recent cuts, long-term bond yields are staying stubbornly high.
So the market isn't buying it.
The market is pricing in long-term risk. It's effectively saying we don't really trust governments to handle this much debt without, just printing money.
So the old playbook, just slam rates to zero and stimulate growth, that's off the table. The debt itself makes it too painful.
It would be excruciating. The government would be spending a huge chunk of its budget just servicing its existing debt. That's the core constraint.
Wow.
The cost of carrying that debt is eating up more and more of national budgets, which limits everything else. And critically, it limits future rate cuts. We're stuck in this very narrow channel.
A channel where if rates go up, the debt load is crushing.
Exactly. But if rates drop too far, inflation roars back because the market thinks the only way out is devaluing the currency. It makes the market hypersensitive to any fiscal mistake.
Okay, so let's talk about those 2025 rate cuts. The media always spins it as a positive thing. Rates are lower, easing is here. But what do they really mean in this high debt world?
And that is the most critical insight, I think, for the individual investor. Yes, rate cuts signal support for the market, for growth, but they do something far more specific. They primarily benefit asset owners.
People who already hold stocks, real estate.
The people who hold high-risk assets. It increases the liquidity in the system, which pushes those assets up. It doesn't immediately stimulate the broad economy or help consumers struggling with high prices. It's a financial stabilization tool that favors risk assets, but it just delays the inevitable.
So it kicks the can down the road and the can is getting heavier.
Precisely. It doesn't solve the underlying solvency problem. So the stability you see in the markets is, in a way, an illusion built on liquidity.
And if that liquidity slows down...
If it slows or reverses because of some global shock, that solvency issue becomes visible overnight. Yeah. And that's why you have high markets and high anxiety at the same time. The smart money knows the foundation is shaky.
Okay, so those are the economic handcuffs. Now let's pivot to the biggest technological force, AI. The debt trap is the brittle environment, and AI is the force concentrating capital within it. This isn't just another tech boom, is it?
No, and this point has to be emphasized. We are not talking about speculation like the dot-com era in the late 90s. This is a structural evolution, and it's validated by hard cash.
What do you mean by that?
The companies winning in AI are capturing these. Just disproportionate gains, because they control two things. the core infrastructure and the proprietary data moats.
Right, but we've seen booms before where money just got thrown at anything with .com in its name. How is this AI shift structurally different from that kind of speculation?
It's a barrier to entry. And the capital expenditure. The dot-com boom was mostly speculative business models. The AI boom is being driven by companies spending billions, sometimes hundreds of billions, on actual physical specialized infrastructure.
System chips, data centers, energy.
Exactly. This is real physical capital expenditure that basically locks in their advantage. They are building permanent control. The economic moat isn't just a clever idea, it's a compute barrier that costs more than most countries' GDPs to even try to replicate.
Wow.
And this is what's fueling that critical concentration of wealth, this widening divide between the AI owners, the ones controlling the foundational models and the data and the users, everyone else.
But surely if it's this transformative, there's got to be room for thousands of new companies to innovate.
There's room for applications, yes, but the real returns will be heavily skewed towards the infrastructure providers. That's the warning here.
I see.
While the tech is real, a lot of speculative AI stocks are going to fail because the path to monetization is just incredibly hard when the giants control the hardware and the data. So valuations need intense scrutiny. You have to look for actual dominance, not just a catchy AI pitch deck.
So if all this capital is concentrating among these few AI owners, what does that mean for the average person, the average investor, who's relying on, the cornerstone of modern investing, the index fund?
Right.
Is this the death of passive investing, or at least a major rethink?
It's a serious structural challenge, no doubt. For the last decade, passive investing has been the undisputed champion, right? But it was driven by these same mega caps. Now, look at the data. The S&P 500's performance is historically concentrated.
The Magnificent Seven.
That cohort has accounted for a massive portion of the index's entire return for the last few years.
Which means if you hold a simple market cap weighted index fund, which is the default for millions of people, you are by definition amplifying your exposure to just a handful of companies.
That is the concentration risk. And for a long time, riding those companies felt like the safest bet in the world. But when 30% or more of an index's movement depends on 7 companies, that can flip from safety to danger very quickly.
Right, if 1 or 2 of them stumble.
If they face regulatory trouble, a growth slowdown.
Anything.
The downside volatility for the whole market is magnified. Passive strategies just intensify that crowded trade.
So if the next decade is one of diverging performance, where tech and infrastructure explode but other industries lag, what's the alternative for an investor who still wants that low-cost, hands-off approach?
You have to move beyond strict market cap weighting. I mean, active selection looks more compelling, sure, but if you want to stay passive, alternative weighting is key.
Like what?
Like equal-weighted indexes, for example. Instead of letting a $3 trillion company dominate the fund's exposure, an equal-weighted index treats all 500 companies the same.
And why is that so useful right now in this AI age?
Because it spreads the risk. It gives you exposure to durable, high-quality businesses that haven't seen that initial AI surge yet. It lets you capture value the market cap index ignores, and it reduces your dependence on those 7 names. Adaptability means thinking outside the S&P 500 box.
Which brings us to the really practical part. What should you, the listener, be doing? Let's look at how the smart money, the sophisticated investors, are positioning themselves for this.
The key theme for them is balancing equity exposure with a huge focus on liquidity and defense. We are seeing elevated cash holdings everywhere, much higher than historical averages.
So they're not bearish, they're just waiting.
It's an optionality strategy. They are holding dry powder, waiting for opportunities that will pop up when this concentrated market inevitably has a shock.
And what about hedging against that inflation risk we talked about, the one that's always lurking with high government debt?
That's where you see the allocations to commodities, industrial metals, energy. They're classic, tangible inflation hedges. We also see selective but significant interest in crypto from major institutions.
Not as a growth play.
Not necessarily. More as an alternative, uncorrelated store of value, especially when fiscal stability is so uncertain. And beyond that, there's a clear effort to broaden equity exposure, to hunt for value outside those megacaps, in industrials, healthcare, real infrastructure.
I think a lot of us as individual investors misunderstand diversification. We think owning 10 different index funds is enough. But if they all hold the same top 10 stocks...
You're not diversified. That's the core error. True diversification is about finding uncorrelated sources of return. If all your assets go down together, you're not diversified.
So give us a concrete example of uncorrelated for someone who isn't investing billions.
It could mean looking at things like managed future strategies, real assets, certain low volatility funds, things that just behave differently than the S&P 500. Even just holding that elevated cash position we talked about, high yield savings, short-term T-bills, that's an excellent uncorrelated asset during a stock market sell-off. You need positions that zig when the rest of the market zags.
So that brings us to the bottom line. What does all this mean for your personal strategy over the next decade? It sounds like the focus has to be on adaptability, not prediction.
Absolutely. Success in this new regime really prioritizes three things for the individual. First, and this is non-negotiable, prioritize defense.
Before growth. Way before aggressive growth. Focus on capital preservation. That means quality assets. A real emergency fund that covers 6+ months of expenses and tackling high-interest debt. You cannot play offense if your defense is weak.
That's a huge mindset shift when the market is booming.
Yeah.
Okay, what's the second pillar?
It's the idea that skills outweigh assets. Financial literacy, disciplined habits. They're always going to be more valuable than chasing a hot stock tip. Your disciplined, consistent saving, avoiding panic selling, that's your most powerful edge.
And the third element?
Embrace optionality. You can't predict the future, especially now, so you need to stay flexible. And you do that with diversified, low-cost holdings. Broad index funds, maybe coupled with some of those alternative weighting strategies we talked about.
The practical steps.
The practical steps are still key. Maximize your tax-advantaged accounts, make consistent contributions, and rebalance periodically to manage that risk.
That brings us to a final thought for you to think about. We've talked about how AI fundamentally concentrates wealth among the owners through these massive compute and data barriers.
If that trend continues, and certain types of human labor become obsolete or just dramatically cheaper, how does that change the very definition of labor, of wealth creation, and the path to financial security for the average person in the years to come? It's a question that goes way beyond quarterly earnings reports.
It really does.
Thank you for joining us for this crucial deep dive. We really hope this gives you some clarity and some actionable insights to navigate this very complex environment. Please try out our latest episodes. We have plenty more to uncover.